Briefly on the legal side, the content of this video is for educational and informational purposes only. It does not constitute investment advice or a recommendation to buy. All analyses, models, and strategies represent personal opinions. No guarantee of accuracy or completeness is given. The full disclaimer can be found at the end of this video and in the video description.
September 2025, the exciting question, peaceful sleep or missed returns? Welcome back to Learn for Finance. Axel, you have a big portfolio update for us, but tell me, why this time as a separate video?
Because it's simply clearer. Previously, we combined analysis and portfolio in one video. It became too long. Now we separate. Here is the portfolio update, there the strategy analyses. This keeps it concise and understandable.
Less talk, more focus.
Exactly. Learning means investing time, but not wasting time.
Axel, today there's a really exciting September update. You introduced some new features in the Seasonal Equity Strategy 2025, already linked above in the podcast. Will they already have an impact on the portfolio?
Exactly, Lisa. Relying solely on seasonality is not enough. The hit rates often look great, but crashes, false signals, and lost trades are the harsh reality. That's why we have incorporated qualitative additions. Goal: fewer false signals. For September, the effects are still limited. But in October, with its flood of signals, we definitely need a ranking by attractiveness. Just like we showed in the linked video.
Also gladiator training for stocks? Only the toughest make it into the ranking?
Exactly. Every stock must be scrutinized. Not only seasonality, but also fundamentals, valuation, moat, fair value, and shareholder focus. In the end, there is a clear ranking. Who has a chance? Who gets eliminated? This is especially important in October because so many entry signals come together.
Sounds like an arena fight. I'm curious who will survive this September.
But now we are starting with the portfolio analysis, specifically with the performance chart.
Axel, so here we see the performance chart. 2 lines, red and gray. Explain to us, which one is what?
ROT is our seasonal depot since the start of 2024. Gray is the MSCI World as the benchmark. One can identify 3 phases. 1. Upswing. 2024, our depot performed strongly, sometimes even better than the index. In bullish markets, seasonality works very well. 2. Correction. 2025, Q2, larger minus 20%. Both fall, but our decline was smaller. 3. V-shaped recovery, 2025. Here, the MSCI quickly pulled ahead. Our depot slowed down because the system increases liquidity in such phases.
Does it mean deliberately slower?
Jane, 2 reasons. Firstly, in summer, the system becomes more risk-averse. Position sizes decrease, exactly where historically most drops have occurred. When the market then suddenly rises, as it did in September, we participate less. Secondly, profits are not reinvested. We maintain a high cash buffer to be able to buy back during setbacks. In a V-shaped recovery, this acts like a brake, intentionally.
Also, red means portfolio, more defensive due to high cash ratio. Gray means MSCI, quicker in recovery, means less pain in the drawdown, but also less rocket start in the counter movement.
Exactly. That is system logic. Controlled risk rather than maximum speed. Whether we can even beat the MSCI in the long run will become clear, but the goal is clear. Capital preservation and peaceful sleep.
Axel, so this is the risk-return chart. Explain to us, how do you read these points?
Very simple. The red dot is our seasonal depot. The gray dot is the MSCI World. The axis, horizontal represents volatility, i.e. fluctuation, and vertical represents return. You can see immediately, our depot is on the left at around 10.7% volatility, while the MSCI is at 16%, meaning significantly less risk.
And what about the break-ins? That is, the drawdown?
We are also more defensive there. Our maximum drawdown was minus 11%, compared to MSCI's minus 21 to minus 22%. That means half the pain in a downturn. And that is exactly the goal.
But up there, I see a gap in the return. MSCI currently plus 15%, our portfolio only about plus 3%.
Correctly observed. That is the price one must pay temporarily. As explained in the performance chart, in rare cases like 2025, V-shaped recoveries last longer and even extend into the seasonally weak months of August, September, October, precisely when the system is almost entirely in cash. These strong differences in performance then occur. In short, controlled risk instead of maximum return. Those who stay invested always ride the rally but never get out.
Also, lower volatility, smaller drawdown, but currently a performance gap. It means protection during crashes, but less boost in V-shaped recoveries. Perfect for turbulent markets, a bit too defensive for rocket launches.
Exactly. That is the logic. Capital preservation before full throttle. And that fits the claim of the strategy.
Loss is clear. Our depot started at $100,000, now $125,633. But the blue line makes me curious. $115,000 cash? Axel, explain. Almost everything is cash. Sounds boring.
That is the cash component. And that's where it gets interesting. From the third quarter of 2025, you will see how the system has massively increased liquidity. This is no coincidence, but system logic. In riskier phases, the model increases cash reserves.
Quickly, the entire depot in cash? That's quite intense. Now I also understand better the performance gap to MSCI and your withholding of the profits.
Exactly. The profits from 2024 were deliberately not reinvested, but kept as a reserve. This secures the portfolio and provides ammunition in case of stronger corrections. The chart illustrates this well. Flat performance, sharp increase in cash proportion. This is pure risk management.
Less action, more safety. But what if it just continues unabated? Under the motto, this time is different?
That's where it gets dangerous. Historically, those have always been the last words before major setbacks. My guiding principle: be brave when others are afraid, and become cautious when everyone around you is too brave.
Let's look at the bear figures for 2025. Plus 3.8% return, approximately $5,000 profit. 2024 was significantly stronger, wasn't it?
In 2024, it was plus 21%. However, 2025 was weak. Drawdown minus 12% versus minus 21% MSCI. Volatility 10.7% versus 16%. Defensive. Problem. Hit rate only 27 out of 34 trades. In contrast, 2024 is almost flawless, 47 out of 9. Since the start, 74 to 53 or 58%. Also high turnover, 182%. Fees 1,273s in 2025 alone.
It means stable in risk, weak in hit rate.
Exactly, and that's why the system expansion.
Back to the start year 2024, how did it go?
Bear strong, plus 21%. 22,585 profit, drawdown only minus 5.95%, hit rate 47 to 9. Weakness, high turnover of 300%. This drives up costs, but as long as profits are good, it's acceptable.
And the overall picture for 2024 to 2025?
Since the start in the overall picture, plus 25.66% after fees and a sharp ratio of over 1.1. That means a very good risk-reward ratio despite the weak year 2025.
Axel, let's take a look at the depot in the end. Which titles are currently in it?
From August, we still have Total and ING in stock. New in September are Booz Allen, somewhat higher weighted, and Nike, but deliberately lower weighted.
And how have the most recently sold positions developed?
We had a few clear winners. MedParts up 46%, Apple up 13%, Salesforce up 4%. But also disappointments. EPAM Systems down 14%, Ferrari down 1.7%, and Games Workshop practically unchanged.
Also a mixed bag from turbo to zero.
Exactly. And the weighting at Booz Allen and Nike was no coincidence. Booz Allen was at the top of the ranking, while Nike was significantly lower down. That's why I weighted Booz Allen more heavily. The other two September candidates, Befesa and Infineon, will only be added to the portfolio once their September signals are received.
It means clear focus, lots of cash, and quality determines who gets into the portfolio.
Exactly. Less gut feeling, more systematic approach.
And the most important lesson from this year?
Seasonality alone is not enough. Therefore, we now additionally examine fundamentals, valuation, moat, fair value, and shareholder focus. Only those who pass will make it into the ranking. Cash remains ammunition, not ballast.
And now it's your turn. Better to seize all opportunities, or rather sleep more peacefully with cash reserve? Write it to us in the comments.
If you like our update, like, subscribe, bell. Thanks for being here. See you next time.
Disclaimer: the content on the YouTube channel, Learn for Finance, is for educational and informational purposes only. All analyses, quantitative models, strategies, data preparations and content presented reflect solely personal opinions and interpretations. There is expressly no individual investment advice or recommendation to buy, sell or hold financial instruments within the meaning of Section 32 of the German Banking Act, KWG, or Section 85 of the German Securities Trading Act, WPHG. The information provided does not replace professional financial, tax or legal advice. The channel operator assumes no liability for the accuracy, completeness, or timeliness of the content. Viewers make investment decisions independently and at their own risk. Past performance, simulations or forecasts are no guarantee of future results. Important note: investments in financial instruments involve significant risks, including the total loss of capital. Please consider seeking independent advice from qualified professionals before making any investment decision.